In 1929, Wall Street broke and the United States descended into the Great Depression. Over the next 3 years, equities collapsed by 89%. 1 in 4 Americans was out of work. Banks failed. Lifetime savings vanished. It took 25 years for the market to return to its pre-crash level. In 2008, the housing implosion set off the Great Recession. Stock indexes fell 57% in 18 months. Unemployment hit 10%. Major banks required bailouts. Retirement accounts were crushed. Markets needed roughly 5 years to regain their losses. But 2025 is not a repeat of either episode. This time, stocks, bonds, and property are falling together in what financial historians call the everything bubble. When everything declines at once, there is nowhere to hide. The better comparison is that we are effectively standing in 1928, on the brink only worse, because the emergency tools used after 1929 and again after 2008 have been largely spent. The Federal Reserve cannot simply cut rates to zero. Policy rates are already low by historical standards. It cannot create limitless new money. The last round ignited the most intense inflation in 40 years. The federal government cannot rescue everyone. Washington is already burdened with $36 trillion of debt. Here is why the main indicators are flashing red, why the likely crash window runs from November 2025 through June 2026, and why the next downturn could erase more wealth than any prior event. This is not speculation, it is mathematics. To understand what makes 2025 different, recognize that we are not dealing with a single bubble, but 3 simultaneous bubbles without precedent in combination. Start with equities. The S&P 500 trades around a price-to-earnings ratio of 28, close to double its long-term range of 15 to 17. That degree of overvaluation has appeared only twice before, in 1929, just before the Depression, and in 2000, just before the dot-com collapse that stripped 78% from the NASDAQ. In both cases, the break arrived within months of those extremes. A second danger is concentration. In 2025, 7 giants Apple, Microsoft, Nvidia, Amazon, Alphabet, Google, Meta, and Tesla represent about 30% of the S&P 500's market value. If these 7 stumble, the index sinks with them. This level of top-heaviness has not been seen since 1929, when a few industrial leaders held the tape up right before it failed. In 2000, tech was frothy, but it comprised a smaller share of the broader market. Today's concentration is more extreme, more brittle, and more dangerous. Nvidia illustrates today's exuberance. The stock trades at more than 65 times earnings. Investors pay $65 for each dollar of profit. Its market capitalization exceeds $3 trillion larger than the entire German stock market. Even though Germany is the world's 4th largest economy, that is not sober valuation. It is speculation driven by artificial intelligence enthusiasm, echoing the internet mania of 1999. People were right about the long-run impact of the web. They were disastrously wrong about near-term prices. The same mismatch is now playing out with AI. Bubble 2 is real estate, and by several measures it is more stretched than the 2008 housing boom that nearly wrecked global finance. As of November 2025, home prices sit roughly 50% above their long-term trend relative to incomes and rents. At the 2008 peak, the overshoot was about 35%. That implies the current housing distortion is approximately 43% larger than the one that triggered the Great Recession. Residential property is only part of the story. Commercial real estate is deteriorating in slow motion and is likely to accelerate through 2025 and 2026. Office space across the United States stands near 45% vacant on a functional basis, as remote work becomes permanent. San Francisco's office vacancy rate is near 35%. Many buildings were financed when interest rates were roughly 3%. As those loans mature, refinancing at 7 to 9% destroys the cash flow math. The assets are not valuable enough to cover interest costs that have effectively tripled. That dynamic sets up defaults, bank losses, and a chain reaction reminiscent of the 2008 subprime crisis. Only now, the stress is in offices instead of suburban houses. The third bubble, The feature that makes 2025 truly unprecedented sits in bonds. Government debt has historically provided the safe harbor when stocks sink. In 1929, treasuries were stable while equities were crushed. In 2008, treasuries rallied as investors fled to safety. In 2025, bonds are selling off alongside stocks because the federal government has issued so much paper that demand cannot keep pace. Total federal liabilities exceed $36 trillion, about 125% of GDP. That ratio matches the level reached at the end of World War II, but post-war America was the only undamaged major economy. Today, the U.S. competes with countries that carry less debt and have stronger balance sheets. Annual interest outlays now exceed $1.2 trillion, making them the largest line item in the budget, larger than defense, larger than Social Security. When interest consumes the lion's share, the government faces three unappealing choices: cut spending sharply and cause a recession, raise taxes sharply and cause a recession, or monetize the debt and trigger inflation. All three roads lead to crisis. When the interest bill alone rivals Mexico's GDP, painless options do not exist. This is the everything bubble. Equities price like past pre-crash peaks. Housing even more overvalued than in 2008. And bonds destabilized by a sovereign debt load that cannot be managed without pain. The parallels to 1929 are uncomfortably close. Valuations then reached records. The Dow's price-to-earnings ratio touched 33. In 2025, the S&P 500 is around 28 times earnings. In 1929, the public believed that electrification, radio, and the automobile had created a new economic order in which traditional valuation rules no longer applied. In 2025, AI is cast in that same role, allegedly exempting markets from gravity. Margin debt hit records in the late 1920s as professionals and ordinary citizens borrowed to speculate. Headlines told of overnight fortunes. In 2025, margin debt relative to GDP is similarly stretched, but leverage now reaches far beyond traditional margin accounts. Retail options trading has exploded. Some households are using credit cards to buy stocks. Corporations have borrowed heavily to buy back shares at elevated prices. Leverage hides throughout the system derivatives, options, and balance sheets that most people never see. Inequality was severe in 1929. The top 1% captured about 25% of total income, leaving growth dependent on a narrow elite's spending. When that spending paused, the machine stalled. In 2025, concentration is worse. The top 1% controls roughly 32% of wealth, and the top 10% drives about 70% of consumer spending. If affluent households pull back as portfolios fall, demand disappears and the economy buckles. Here is where 2025 is harsher than 1929. Back then, only about 10% of households owned stocks, which meant most people's savings were not vaporized in the initial break. They suffered later through deflation and joblessness. In 2025, roughly 58% of households have equity exposure directly or via retirement plans like 401ks and IRAs. A market collapse would instantly destroy the nest eggs of more than half the country. There is no buffer. The banking setup differs as well. In 1929, thousands of small banks without federal insurance failed when depositors panicked. Today, FDIC insurance promises coverage up to $250,000 per depositor. But the fund holds only about $125 billion while insuring roughly $10 trillion balances. If several major institutions fail at once, that backstop is inadequate. To make depositors whole, authorities would need to create money on a massive scale, which would fuel inflation and weaken the currency. Either depositors lose through failures or they lose through inflation. It is a grim choice. The Federal Reserve's credibility and toolkit have also changed. In 1929, the institution was young, with room to cut, and without decades of boom-bust cycles behind it, though it misread the moment. In 2025, the Fed has spent 15 years demonstrating the limits of its power. Quantitative easing after 2008 inflated a huge asset boom. Keeping rates too low for too long helped create the current everything bubble. Then the aggressive tightening in 2022-2023 fought inflation, while simultaneously threatening a hard landing. credibility has eroded, and the tools themselves have lost potency. The moves that stabilized 2008 can no longer be repeated with the same effect. The 2008 financial crisis provides the nearer analogy. It started with subprime mortgages packaged into complex securities and sold worldwide. Once home prices stopped rising, refinancing ended and defaults cascaded, revealing banks' leverage and the worthlessness of the mortgage-backed paper they held. In 2025, subprime behavior is everywhere, only under different labels. Auto loans run to 84 months at high rates for weak borrowers. Credit card balances stand at records with average APRs above 21%. Student loans total about $1.77 trillion that will not be fully repaid. Corporate borrowing has ballooned from roughly $2 trillion in 2008 to more than $10 trillion, often funding buybacks rather than productive investment. In 2008, leverage concentrated in housing and mortgage bonds. Lehman Brothers ran roughly 30-1. A 3% asset decline erased its equity. Its September 2008 collapse triggered panic. In 2025, leverage is diffuse. The derivatives market exceeds $600 trillion in notional value, around 10 times global GDP, dominated by interest rate swaps and credit protection that can detonate if yields jump or if defaults mount. Interconnections mean one failure sparks others in a chain. Back then, the Fed had room to act. Policy rates began near 5.25%, leaving ample space to cut to zero and spur borrowing. Quantitative easing poured trillions into treasuries and mortgage-backed securities, expanding the Fed's balance sheet from around $800 billion to about $4 trillion by 2014. That intervention prevented collapse but inflated the conditions we face now. In 2025, policy space is cramped, rates are already low relative to long-run history. Slashing them risks reigniting the same inflation that required painful hikes to restrain. Refusing to cut risks a depression-style downturn. QE is similarly constrained. After multiple rounds, the balance sheet still sits above $7 trillion. Printing more is possible, but the public now understands the inflationary consequences. 2021 through 2023 proved that unlimited money creation erodes purchasing power. The Fed is boxed in, print and debase, or hold and endure a deflationary bust. The 2008 playbook has been used up. Government rescue capacity is also depleted. In 2008, the debt burden was near 67% of GDP, allowing Washington to borrow for bailouts. TARP authorized $700 billion together with other programs. The support approached $2 trillion. It was unpopular but feasible. In 2025, federal debt hovers around 125% of GDP, with trillion-dollar deficits stretching ahead. Attempting another multi-trillion-dollar rescue would likely provoke a bond market revolt, pushing yields even higher and making the interest burden still more unsustainable. The option that stabilized 2008 is not available at the same scale. Internationally, 2025 is tougher. In 2008, China's boom helped pull the world out with stimulus and commodities demand. Europe, though battered, coordinated through the G20 and was not mired in the same debt trap. In 2025, China faces a property bust, local government obligations above $13 trillion, and a shrinking population. Europe struggles with energy constraints, demographic decline, and political fragmentation. No major economy is positioned to lead a synchronized recovery, and geopolitics impedes cooperation. In a crisis, countries will prioritize national survival over joint solutions. The most reliable U.S. recession signal since 1950 has been the inverted yield curve short rates above long rates. It has predicted every downturn with no false positives. The curve inverted in July 2022 and stayed inverted for 27 months, normalizing in September 2024. Historically, recessions begin 3 to 12 months after normalization, not during inversion. That places the danger window from October 2024 through September 2025. We are inside it now. The signal with the cleanest record points to an imminent downturn. Consumer debt shows the same stress lines. Credit card balances exceed $114 trillion stars, an all-time nominal high. The average household carries about 6,800, with APRs typically 21% to 28%. 90-plus day delinquencies have risen to levels last seen in 2011. Since consumption is roughly 68% of U.S. GDP, a consumer forced to shift from spending to debt service drags the economy lower. We have reached that point. The commercial property squeeze will intensify across 2025 to 2026 as more than $2 trillion in mortgages come due. These loans worked at 3% interest. At 7 to 9%, many buildings are insolvent. Prices have already fallen 40-60% in numerous markets because buyers know the cash flow cannot support current rates. When refinancing fails, borrowers default and surrender properties. Regional banks take the hit. Capital is impaired. The 2023 failures were a warning. Silicon Valley Bank collapsed in March 2023, the second largest failure on record. Signature failed the same week. First Republic fell in May and was absorbed by J.P. Morgan with FDIC support. And New York Community Bank wobbled in January 2024. Those ruptures occurred without an official recession. When the downturn arrives and defaults surge, dozens more regionals are at risk. The FDIC's roughly $125 billion fund would be depleted within weeks in a multi-bank event, forcing money creation to protect depositors and undermining the currency further. Market structure compounds the fragility. The Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, comprise about 30% of the S&P 500. Nvidia alone, with a PEE north of 65, represents roughly 7% of the entire index. An earnings miss or weak guidance could lop 50-70% off that one stock. Given its weight, the index would fall on impact, and the blow to the AI narrative would likely drag the rest down in sympathy. In a sell-off, margin calls convert declines into spirals. Borrowers must post more collateral. If they cannot, brokers liquidate positions, pushing prices lower and triggering additional calls. That reflex loop deepened the 1929 collapse. In 2025, margin relative to market size is similarly elevated. On top of that, institutional risk systems enforce selling when losses breach thresholds. Combine retail panic, forced deleveraging, and rules-based selling, and a 30-40% drop in the first month is feasible. From there, stress jumps to bonds as investors grope for safety. But in 2025, treasuries are no haven because Washington must issue massive amounts of new debt to fund deficits and roll maturities. If safe haven flows collide with heavy issuance, yields can rise anyway. That sets up a doom loop. Higher rates inflate the government's interest bill, which requires more borrowing, which requires selling more bonds, which pushes rates even higher. Countries caught in loops like this end either in default or in inflation that hollows out the currency. The housing market then locks up as demand vanishes and sellers cling to yesterday's prices. Listings linger for months without credible offers. Households that must sell because of relocation, liquidity needs, or distress start cutting. Those reductions set the new comparable sales and drag valuations down across entire neighborhoods. Within 6 months, national prices can be 20-30% below the peak. Within a year, 40-50% drawdowns are realistic in overheated metros such as Austin, Phoenix, Boise, and parts of California and Florida. Buyers from the last 3 years find themselves underwater, owing more than their properties are worth. Commercial real estate defaults accelerate once owners accept they cannot refinance maturing debt. Payments stop. Keys are handed to lenders. The bank, often a regional institution, takes possession of a building worth 40 and 60% less than the outstanding loan. Those losses are realized and immediate. Capital gets wiped out. Because banks must meet minimum capital ratios, breaches trigger regulatory closures. From 2008 to 2012, 465 banks failed. In the next break, totals could match or exceed that figure over a compressed period, clustered among regionals. Failures ignite classic bank runs that can spread even to institutions that are fundamentally sound. Headlines spook depositors, who rush to pull funds from any bank they perceive as vulnerable. No bank can satisfy simultaneous withdrawals because deposits are loaned out or invested. To raise cash, institutions sell assets into weak markets at depressed prices, crystallizing losses that can turn a formerly solvent bank insolvent. The FDIC steps in, but its roughly $125 billion fund is nowhere near sufficient to resolve multiple large failures while ensuring roughly $10 trillion in covered deposits. To make depositors whole, the government would have to create money on a massive scale, fueling inflation and degrading the currency. Depositors either lose through failure or lose through inflation. That is the trade-off. Employment then cracks as revenues fall and companies cut costs. Overextended tech firms trim 10 to 20% of staff. Financial companies exposed to market turmoil shed jobs. Consumer-facing businesses, facing households that cannot spend, close stores and lay off workers. Within 3 months of the initial break, unemployment can jump from around 4% to 7 to 8%. Within 6 months, 10% is plausible. Within a year, 12 to 15% is likely as second-round effects propagate. The Federal Reserve faces an impossible choice. It can slash rates and resume quantitative easing to stabilize markets. But that risks reigniting the same inflation that ravaged purchasing power in 2021-2023. If it opens the spigots and prints trillions again, the dollar weakens and price pressures return with greater force. If it refuses, the downturn deepens toward depression. There is no comfortable middle path. The tools that worked in 2008 no longer function in 2025 because they have been used to excess, and the side effects are now widely understood. For ordinary savers with 401ks and IRAs, a 60-70% drawdown is not theoretical, it is devastating. A person who has spent 30 years building a $600,000 nest egg could watch it fall to $200,000 or less. That is not a routine correction. It ruins retirement plans. Many will work an extra decade or more, assuming jobs exist during the slump. For people already retired and relying on portfolio withdrawals, the situation is worse. They become forced sellers near the bottom just to pay bills, locking in losses they will never recoup. The psychological shock is profound. In 2008, balances fell but returned to even in roughly 5.5 years for those who refused to sell. In the coming break, the climb back could take far longer if a full recovery arrives at all. Japan's stock market peaked in 1990 and did not reclaim those highs until 2024, 34 years later. A generation of Japanese investors never recovered its lost wealth. If the U.S. crash is deep enough and the healing slow enough, a similar outcome is possible. Housing wealth destruction traps millions of owners. People who bought recently cannot sell without eating losses. Many owe more than the home is worth. The job market becomes punishing for newcomers. Graduates in 2026 and 2027 will confront hiring freezes and oversubscribed entry-level postings. Those who do land roles begin 5 to 10 years behind, depressing lifetime incomes. Research on the cohort that graduated into the 2008 downturn already showed persistent income penalties. If the next downturn is worse, the scarring will be deeper and longer. Small businesses take the hardest hit. As consumer spending collapses and credit dries up, independent restaurants, local retailers, and family service firms fail by the hundreds of thousands. Large corporations with access to capital markets survive, smaller but intact. The post-crash economy becomes even more dominated by giant firms, with small enterprises playing a diminished role. That weakens competition, innovation, and overall dynamism. Social safety nets are stretched beyond capacity as unemployment surges and tax receipts fall. Government is trapped between swelling demand for assistance and a reduced ability to fund it. Spending cuts arrive even as needs rise. That turns an economic crisis into a humanitarian one as vulnerable groups, the elderly, the disabled, the unemployed, face reduced support precisely when they need it most. Political instability follows economic breakdown. The 1930s saw extremist movements surge across Europe as hardship made simple authoritarian promises attractive. Weimar Germany's currency collapse helped pave the way to disaster. The United States is not immune to political consequences during economic crises. When people lose everything, they look for culprits and for radical solutions. A 2025 break would reshape American politics in ways that are hard to predict, but likely destabilizing. Why then is 2025 worse than 1929 and 2008 combined? Because it fuses the equity excess of 1929, the debt and housing fragility of 2008, and a sovereign debt problem that neither previous crisis faced. All three are occurring at once. In 1929, stocks collapsed, but only about 10% of households were directly invested. In 2008, housing crashed, but Washington could still borrow for bailouts, and the Fed could print without instantly unleashing 1970s-style inflation. In 2025, all major asset classes fall together, and the usual toolkit is exhausted. The Fed cannot simply cut rates to zero because inflation remains elevated. It cannot print without consequence because the last episode produced the worst inflation in 40 years. The government cannot bail out everyone with a debt load already near $36 trillion. The 12 warning signs described here, from the inverted yield curve to disciplined investors hoarding cash, are not conjecture. They are observable facts. The curve, which has never issued a false signal, says a recession is near. Regional banks are failing at the edges. Commercial real estate is cracking. Consumer debt is at records with delinquencies rising. Unemployment is ticking up. Insider selling is at levels that have historically preceded major breaks. All indicators are flashing red at once. The timeline is visible too. The curve normalized in September 2024, and historically recessions arrive 3 to 12 months later. That places the risk window in December 2025 through September 2026. Meanwhile, commercial mortgage refinancing peaks in 2025 and 2026. Credit card defaults are already accelerating. The spark could be anything: an earnings miss at a dominant tech firm, a larger-than-expected regional bank failure, a geopolitical escalation, or a breakdown in debt ceiling negotiations. The identity of the trigger matters less than what follows. One failure sets off another, until the financial system is in free fall. If NVIDIA or another member of the Magnificent Seven misses expectations or guides weakly, algorithmic trading systems will sell immediately. A 10-15% single-day drop is plausible. Because NVIDIA is roughly 7% of the S&P 500, that alone cuts the index around 0.7%. The bigger impact is psychological. If the AI story that has supported valuations starts to fray, investors re-rate megacap tech across the board. Microsoft, Apple, Amazon, Alphabet, Meta, and Tesla sell off in sympathy. Within days, those 7 could be down 20-30%, taking the index off 6 to 9%. Margin calls then turn a slide into a plunge. Leveraged investors must post cash. If they cannot, brokers liquidate, driving prices lower and triggering additional calls. That feedback loop helped define 1929. In 2025, margin relative to market size is likewise elevated. Institutional mechanics magnify the move. Pension funds, endowments, and sovereign wealth funds run model-based risk limits that force them to sell when drawdowns cross preset thresholds. These are not emotional decisions. They are mandated. Combine retail panic, forced deleveraging, and rules-based selling, and a 30-40% decline in the first month of a crash is feasible. From there, the stress migrates to fixed income, as investors grope for a safe harbor that no longer exists. The Treasury must issue massive amounts of new debt to fund deficits and roll maturing obligations. If safe haven flows collide with heavy issuance, yields can still rise. That is the doom loop. Higher rates raise the government's interest tab, which requires more borrowing, which requires selling still more bonds, which pushes rates higher again. Countries trapped in such loops typically end in outright default or inflationary currency erosion. As that loop spins, the housing market endures its own chain reaction. Buyers retreat, sellers resist, and transactions freeze. The forced sales that do occur establish new lower comps, pulling prices down further. Within 6 months, national prices are 20-30% off the top. Within a year, the most inflated regions show 40-50% declines. Negative equity spreads. Commercial real estate losses boomerang back through bank balance sheets. Capital is impaired. Regulators close institutions. Panic broadens. The FDIC's fund is drained in weeks during a multi-bank event and is replenished with newly created money-intensifying inflation risks. Labor markets then roll over decisively. Layoffs sweep through tech, finance, and discretionary sectors. Unemployment enters double digits within months. The Fed must choose, print and risk inflation, or refuse and accept depression-level joblessness. Either option carries severe costs. For savers and retirees, portfolios shrink beyond practical repair. For small businesses, credit disappears. Safety nets groan. Politics grows volatile. This is what an everything bubble bursting looks like. Stocks falling 65–80% from the top. Bonds losing 35–50%. A scale of fixed income drawdown not seen in previous crises. Real estate down 40–60%, worse than 2008. Unemployment exceeding 15%. The subsequent recovery does not resemble 2008's 5-year round trip. It stretches 10 to 20 years or longer because the Fed's firepower is depleted and fiscal space is constrained. The epic crashes we assumed belong to history repeat, only faster and across more assets. The arithmetic of untenable debt, inflated prices, and exhausted policy tools makes the outcome unavoidable. The break is coming. The only uncertainty is whether people will be prepared when it arrives.